In this video, I look at where to invest in 2025, which countries, which sectors, and also which asset classes, gold, bonds, or credit. And because it's forecasting season, we can take our annual look and make slight fun of the broker forecast for the end of 2025. And then finally, I'll tell you what I think are the best bets for the coming year. Don't forget that if you enjoy our content, please do like this video and subscribe to our channel. Let's begin by looking at US valuations. The reason for that is that the US market is so large that if you have a global index fund, it's going to be dominated by US stocks. They'll make up 65 to 70% of your overall portfolio. So here, for example, is the excess Cape yield measure from Robert Shiller. What this measures is the expensiveness of US stocks adjusted for interest rates, because when interest rates are low, that tends to push up valuations. And what we can see here on the x-axis is expensiveness at the beginning of a decade. So expensive is on the left and cheap is on the right. And then we track stock markets for the following decade and look at the total real return. And that's what we see on the y-axis. Now notice the line is upward sloping such that when stocks start the decade expensive, you get lower returns. And when they start off the decade cheap, you get higher returns. Valuations right now are the dashed yellow line, and you can see that that suggests that returns won't be great, for the US market at least, over the next decade. Now notice there's a lot of uncertainty in that forecast. There's a huge dispersion of points around this slice that we're in currently. But if we look at the time series of expensiveness to gauge how extreme the current expensiveness is, you can see that the US has only been more expensive 20% of the time since 1880. So not the most expensive it's ever been, but still high valuations. Now it's always good to look at more than one valuation measure. The excess Cape yield is backward looking. This is a forward looking measure. It looks at the price of the S&P today divided by its forecast earnings. It's the forward price to earnings multiple. And investors are currently willing to pay $22 for every dollar of profit. Now this is roughly where we were at the euphoria stage after the pandemic, when people were buying lots of meme stocks and cryptocurrency was going crazy. It looks like we're kind of there again. The reason why that matters is that if we start off with expensive stocks today, usually that reduces future returns. The only way stocks can climb higher is either by re-rating even further upwards, in other words, becoming even more euphoric, or for earnings to really tear upwards. So now let's take a look at those broker earnings forecasts to see what analysts expect. So here in blue, you can see the historic earnings generated by the S&P 500, and in yellow, you can see the forecast for the 2 years ahead. And this is an aggregated forecast from multiple brokers. The good news is that it's a fairly brisk rate of growth. Earnings are not going to stall, they're going to carry on growing fairly briskly for the next 2 years. At least that's the expectation. If we convert that into a year-on-year growth rate for US earnings, you can see that that growth will be pretty brisk. Again, the historic growth rates here are shown in blue, and the forecast for the next 2 years is shown in red. And in fact, what we're seeing is an acceleration of that growth rate towards the end of this 2-year period. Now, what has many people worried at the moment is that the US market is very concentrated in a handful of stocks. Some people call this the Magnificent Seven. Here we've got the Magnificent Eight because that's what Ed Yardeni calls it. And there is a slight concern here, which is to do with the amount of profit and revenue which these companies are generating. Now, as a proportion of the index, these stocks make up about 30% of the S&P. However, they only generate about 12% of the revenue and about 22% of the profits for the S&P. So they are punching above their weight, albeit slightly when it comes to profits. So that suggests that people are overpaying for the Magnificent Eight and there could be a correction ahead. But it's certainly not the case that all markets are expensive or that all parts of the US market are expensive. So let's start by looking across countries to see where valuations are more reasonable. Now what I'm showing here is a Cape measure, so this is Robert Shiller's cyclically adjusted price to earnings ratio, but I've compared each country with its own history to see what proportion of the time it's been cheaper. So for example, if we're at 100%, then the country's been cheaper 100% of the time. This is its most expensive valuation. And for the countries at the top of this table, you can see that they're not far off that. So for example, Taiwan, India, the US, all of those have been cheaper 90% of the time or more. Then at the other end of the table, if we look at the cheap countries, you can see the UK's been cheaper 39% of the time. And then at the very bottom end of the table, the really cheap countries, we're looking at Hong Kong, Poland, Mexico, Turkey, South Africa, and of course China. Those countries are at very low valuations compared to their own histories. So if you are contrarian and you think, well, I'll just buy the cheap countries, remember that they're always cheap for a reason. So it's never the case that a really attractive country with great prospects is at the cheap end of the table, but perhaps there's an unfair pricing here in some cases. So if we look at the time series for the expensiveness measure, and here we're doing it for two expensive countries, that's India and the US, and also for two cheap countries, which is China and the UK, notice that the ones which are expensive have been expensive for some time, and the ones which are cheap have also been cheap for some time. So if you are a contrarian, you also have to be patient. So firstly, there's got to be a catalyst for improvement, for cheap countries to get more expensive, and you've got to wait around for that to happen. And of course, there's always the possibility that the country will stay cheap forever. Now that CAPE measure is backward looking, so we're going to look at forward price to earnings multiple by country, and it tells a very similar story. India is very expensive, so's the US, and the UK, Mexico, Italy, China, all of those countries are relatively cheap. So if it is the case that these cheap countries can turn things around and generate good earnings growth, then there is a case to be made for buying these cheap, perhaps underpriced countries. But that's a big if. Now let's look at US sectors, because there as well, there's a big difference in valuation. So here I've ranked US sectors by forward price to earnings multiple, that's the forward-looking measure, and you can see that the usual suspects are expensive. So that's tech and communication services. Remember that Google is treated as a communication services company, for example. And then the unsexy sectors, which are nothing to do with tech, perhaps they're defensives, are at the bottom of the table. So that's sectors like energy, basic materials, and financials. So again, what we see is quite a big dispersion in valuation according to different sectors and according to country. So there is value out there if you're willing to look for it and if you're patient to wait for a turnaround. Now, if we look at the returns of the sectors over the course of 2024, you can see that despite the fact that financials are still cheap, they've had a very good run this year. They're up by the most of any sector. But if we look at what's languishing at the bottom of the returns table for 2024, you can see we have a lot of defensive sectors, things like consumer staples and healthcare. So if you think there's going to be a value turnaround in 2025, those could be interesting to look at. So that's the equity markets. How about other asset types? And we can start with gold. Now, it's been a great year in 2024 for gold. In fact, it's risen by more than the Nasdaq index. And that's very unusual. Now, why is that? Well, it's certainly the case that central banks did a lot of buying of gold over the course of the year, certainly early on in the year. And of course, we've seen the Federal Reserve start to cut interest rates, and that tends to be good for gold. Now, if you have a PensionCraft premium website membership, you get access to these trackers, and one of them is a valuation model for gold. So this uses various inputs. It looks at CPI inflation, it looks at real interest rates, and it looks at the strength of the dollar. And from those three variables, it tries to work out what the fair price of gold should be. Now, currently, the fair price of gold is something like 21.16, and that's about 24% below the actual price of gold, which you can see here in blue. Now, that does suggest that people are overpaying for gold right now, and that would tend to put me off putting too much into the yellow metal right now. But we'll see at the end of the video why you may still want to put money into gold, because it is a defensive asset class, and depending on the scenario for 2025, you may want that safety. Another safe asset class is developed market government bonds. Now, what we've started to see with government bonds in the UK, but also in the US and elsewhere, is we're finally starting to see uninversion of the yield curve. In other words, those short-term interest rates are starting to fall, and you're finally starting to get some compensation for taking more duration risk with longer duration bonds. So here's the yield curve as I make this video. Now it's still the case that you get a dip down to about 5 years, but then we start to see the term premium, as it's called, kick in. And you are starting to be compensated for taking more duration risk. But you have to go all the way out to about 15 years before you start to get rates which are above those really short-term rates, which you could also earn with a money market fund. But whichever bond you choose, you can see that across the whole yield curve, you're generating about 4.6, maybe even up to 4.8% currently. And given that inflation is about 2%, that's not a bad real return for safety. If you like the look of that yield curve tool that you just saw, or perhaps the fair value model for gold, you get access to that as part of our premium website membership. Plus you get lots of other goodies. You get lots of members only videos and of course our chat application, so you can ask a question whenever you like. If you want to learn more about that, just go to our website, pensioncraft.com/membership, and you'll also find a link to that in the description below. So that was government bonds. What if you want to take a bit of credit risk and earn a bit more than you would with those very safe investments? Then you turn to corporate bonds. I still think this market is not attractive, and you can see the reason for that if you look at the credit spread. That's the additional income you receive for taking credit risk. Now this is for US bonds. The situation is very similar in the UK and Europe. The dashed yellow lines that you can see here are the average spreads over a long period of time. Notice that currently the blue lines, the current spreads, are below that dashed yellow line. You're really not being compensated much at all for taking credit risk, no matter what the credit rating. All the way from AAA, the highest credit rating at the top, down to single B, the lowest credit rating which we show on this graph. The best time to buy credit, remember, is when those credit spreads are much wider and you're getting a much better compensation for taking that risk. So at the moment, I think credit is simply unattractive. The risk-free yield you can earn is pretty good, and I'm not personally willing to take this risk in order to generate a slightly higher return. Now, monetary policy, which is the policy rate set by central banks, is also very important in driving asset class returns and, of course, bond yields. And to characterize where we are right now, we've come through this inflation spike, which has abated, and now almost every country is at the kind of sticky remnants of inflation, which is getting quite difficult to get rid of. That often comes in the form of services inflation, and it's due to high wage growth. The standard narrative by central banks in the US, the UK and Europe is that they're going to have to be very cautious as they cut interest rates because they don't want inflation to flare up again. And that seems justified given the fact that this last remnant, the last mile of getting rid of inflation, has turned out to be very difficult. Furthermore, many economists expect that Donald Trump's policies, at least the ones we've heard so far, are very inflationary. That suggests in turn that the Federal Reserve will have to keep rates higher for longer, or may even have to increase rates at a certain point in the future, if indeed those policies do turn out to be inflationary. And if we look at market expectations for what's going to happen to the policy rate in the US, you can see that they're pricing in 2 cuts over the course of the next year. One of those will occur at the Fed's meeting in May, and the other one in October. Now previously we just had a slew of cuts forecast for the course of 2025, but I think this is a reaction to Trump's electoral victory and also his inflationary policies. So inflation has certainly abated to a large extent, and central banks are starting to ease back on policy, but we'll just have to see how sticky that long tail of inflation turns out to be. Now let's turn to some longer term forecasts for the decade ahead. So these forecasts are from Vanguard UK, looking at various asset classes over the next 10 years. What's interesting is that the forecast for UK stocks is pretty good. Somewhere between 5 and 7% is what Vanguard expects. And that's actually a bit better than its Global X UK forecast. The reason for that is that US stocks are so expensive, and that should lower their returns in the decade ahead. Whereas UK stocks are very cheap, and that acts in their favour. But But even if we look at bonds, the returns there look pretty good because yields are now higher, as we saw in that yield table. So something between 4.2 and 5.2 is what you'd expect with UK aggregate bonds. And if we look at the bond market globally, something between 4.4 and 5.4%. So for a 60-40 portfolio, that bodes pretty well for the decade ahead. Vanguard US also produces a forecast in dollar terms, of course. And what's really interesting here is that if you look at US equities as a whole, the return forecast is very poor indeed. But if we look at US growth stocks, the forecast is completely disastrous. In fact, the dashed red line which I show here is the lowest forecast for US treasuries. And in fact, US growth stocks are forecast to have a much lower return than US treasuries. So this is the mega cap tech stocks which have done so well, and consequently, which have grown extremely expensive. So this is the cost of euphoria at the moment in AI and in those mega cap growth stocks. Ultimately, the price you pay is lower forward-looking returns. But if we turn elsewhere, so if US investors were to invest in global equities ex-US, in emerging markets, or even US small caps, those should offer higher returns, at least according to Vanguard's model. And if we look at the US fixed income space, asset types like US high yield or junk bonds are forecast to have a pretty good return, as are emerging market sovereign bonds. Now we've talked about forecasts here, but it's always good to look at base rates. What's a base rate? Well, if you look at super forecasters, what they tend to do is to look at the long-term average. In this case, we're looking at long-term average returns by asset class, and then they adjust it based on new information like valuation, geopolitics, or perhaps monetary policy. This should always be your starting point, the long-term average returns. And it's worth writing these on a post-it note and sticking it on your wall. And these are taken from Dimson, Marsh, Staunton, three great researchers who've looked at long-term returns across different asset types. Now these are total returns, which means that the dividends are reinvested. They're real returns, which means they're inflation adjusted downwards. And they cover a period of about a century. Now these are for the US, and you can see that the real inflation busting investment has been stocks over that period. They've returned about 6% above inflation, bonds about 4% less, and bills or money market funds about 1% less than that. So if you are going to be investing over the long term, these are the returns to remember. So now the comedy segment, let's turn to the analyst forecasts for the year ahead. Now trying to forecast US equity movement or any equity movement over the course of 1 year is kind of like flipping a coin. Stocks become predictable over the long term, certainly not over the short term, as this graph testifies. So here you can see the value of the S&P, that's the blue line, and I've fitted a yellow dashed line to show you the mean path, assuming a return of about 13.2%. If we simply extrapolate that to the end of 2025, you can see that it reaches about 6,100. And as I make this video, that's about 2% above where the S&P is right now. What I've also shown here, and these are the clusters of horizontal yellow lines, are the forecasts made by brokers, usually investment banks, for the level of the S&P at the end of the year ahead. So for example, in 2020, during the pandemic, you can see the forecast that brokers made for the end of 2020. And unsurprisingly, they were pretty glum about the prospects. Remember, this was a very volatile period and people were really worried that things would not recover. As it turned out, the S&P ended the year above even the most optimistic forecast. So brokers revised up their forecast for the following year, but not quite enough as it turned out, because again, the S&P came above even the most optimistic forecast. So analysts learnt their lesson, and the following year, for the end of 2022, they really revised things up a lot, and we had the tech wreck. So that year, the S&P ended below even the worst forecast. You're probably seeing the pattern here now. Brokers then revised things down a lot following the tech wreck, and surprise, surprise, the equity market roared back to life, such that by the end of 2023, the S&P ended above even the most optimistic forecast. Then for this year, the expectation was that we'd be well below where we are already, and that's as I make this video at the end of November. So you can probably guess about what they did to the forecast for 2025. Yes, they made it much more optimistic. So that immediately worries me about the prospects for the year ahead. In conclusion then, I think the backdrop for equities for 2025 is still quite good. Policy rates are falling, so central banks across the world are still cutting interest rates, and that's good for equity. Inflation's come under control. We've got past the big spike in energy prices, at least for now. And if we look at those earnings forecasts, they look very good for the US, certainly. There are still some reservations, of course. If we look at valuations in the US or India, say, they look very stretched. But it's certainly not the case that everywhere is expensive. In the US, small caps are still reasonably priced. The UK's cheap, Germany's cheap, and if you're very brave, so's China. So certainly for me, I think the year ahead looks pretty good. And that's assuming that some of the policies which Donald Trump is talking about don't get fully implemented. But that requires that we don't get a huge escalation of the trade war. So for example, if we have huge counter tariffs to the US tariffs, then we could see a big break on global growth and on corporate profits. But if that doesn't happen, then I think things could be pretty good. And if that's the case, then risky assets like stocks would do well, as they have done this year and the previous year. Also, government bonds would still be okay given the high yields that we're currently seeing. And if you look at styles of investing, then a continuation of what we've seen previously, which is mega cap growth tech stocks doing particularly well, that'll probably continue. And those would outperform quality stocks, for example, but also value stocks. However, if we do see a trade war escalation, and this is the kind of bearish scenario, then that's not going to be so great for risk assets. So in this scenario, you'd have lots of counter tariffs, global growth would slow down, corporate profits would suffer. And in this kind of scenario, safe haven assets like gold, maybe money market funds, maybe cash, and the style of investing that would do well would be things like quality perhaps and income more than growth. Now perhaps I'm being overly optimistic, but I'd favour the blue scenario in which the trade war doesn't escalate. And that's because if Donald Trump's presidency does veer into some policies which are going to damage the economy, then markets will punish that decision and probably change that decision. So that's both the equity market and, of course, the US Treasury market. So with those checks and balances in place in the form of market prices, I think that'll keep things on a steady course. But why don't you tell us what you think in the comments, and I'd be interested to see which path you think the economy will take, and markets as well, of course. Now don't forget, if you did want to join our community and get access to those tools, lots of members-only videos, and of course the chat application so you can ask questions whenever you like, you can do that by going to our website, pensioncraft.com/membership. And, as always, thank you for listening.